Welcome back to the Bitcoin Layer. Today, I am joined by the one and only Lawrence Lepard, of course, a sound money advocate and investment manager at Equity Management Associates. Lawrence, welcome back to the show.
Thanks, Joe. Great to be with you again. I always enjoy being on your show.
Absolutely, we were just talking a little bit before we started recording, and this should certainly be a good episode. Definitely all encompassing everything from Bitcoin and the latest happenings over there, of course, with the political scene and how that's shaping up. And then the nitty gritty macro, right? The policy area that the
There's a
Fed's
lot to
committing.
cover.
Lots to cover. So we'll dive straight into it, I suppose. The first thing I want to chat about here is RFK Jr. So obviously he went out and said that he wanted to back the US dollar with Bitcoin, and obviously that includes US dollar denominated debt. And I have a quote here. I'll share my screen so that you and also the viewers can see it. But I'll start reading it. It says, my plan would be to start very, very small. Perhaps 1% of issued T-bills would be backed by hard currency, by gold, silver, platinum, or Bitcoin. So let's talk about this. What are your thoughts on this? Is this viable? Does this happen? Does this increase or
Well, I mean,
decreases chances?
yeah,
Yeah.
it's anything's theoretically viable. I mean, given the people who are in power today and the odds of Kennedy being elected, I don't know how realistically viable it is. But the notion is a great notion, and I'm sure the way you reacted to this, Joe, the way I did, which is, oh my God, here we have a major
Mhm.
presidential candidate talking about sound money. I mean, whoever, that wasn't on my bingo card, for things happening in this election cycle. And um, even if he loses, just the fact that this is being discussed is really important, in my opinion. And because more people will hear it, more people will think about it, and maybe other candidates will have to answer, how do you feel about this issue, and so on and so forth. And as you know, I strongly believe that the unsound money that we have, that the money is broken, and that's why the world is broken, and all the problems that we're encountering in society, the base layer, it stems from the base layer being broken, which is the money. So this, to me, this is enormous. And when I saw I mean, we've kind of known Kennedy's been supportive of Bitcoin for a while now, so that's not entirely new. But to hear him talk about the U.S. moving the U.S. toward more of a sound money standard, Bitcoin, gold, whatever, boy, that's big. It's a really big development.
Before we get into it, a quick word from our sponsor, River. River is my favorite place to buy Bitcoin. They have zero fees when you dollar cost average and set up a recurring order, but they also have a proprietary cold storage solution so you can rest assured that your Bitcoin is held safely and soundly and not being lent out to counterparties. You can invest in Bitcoin with confidence today at river.com or click the link in the video description below for a special offer. And now, on with the show. It is a big development, and regardless of the chances of this happening, or even
Right.
the viability behind it, I think the more important thing and the thing that you hit on is that it brings it into the national conversation. We haven't had a
Correct.
candidate that's talked about fiscal austerity. It's not something that candidates have talked about. Most candidates just talk about how they can give their constituents more money. But this is the
Right.
first, and a Kennedy, right? And we've talked about this
Yeah.
before, that how revolutionary it is that a Kennedy is advocating
Yeah,
for
absolutely.
Bitcoin
And
and
I
had,
mean,
yeah.
the only candidate in my lifetime that, well, in my later lifetime, I guess Goldwater was probably a sound money guy, but the only, candidate in the last 30, 40 years that was notable in this area was Ron Paul,
Mm.
who, believed in ending the Fed and understood the problems associated with fiat currency. And he did as best he could with what he had, ran for president, but sadly, he's kind of timed out now. And
Mm.
so we need a new group of younger politicians to pick up the battle here.
Absolutely. So we'll talk. I want to talk briefly about the kind of the viability of this and the reason that he wants to do it, and then
Mm,
we'll dive into a little bit of the macro here.
sure.
So he says backing dollars and U.S. debt obligations with hard assets could help restore strength back to the dollar, rein in inflation, and usher in a new era of American financial stability, peace, and prosperity. And then he goes on to say he'll exempt the conversion to Bitcoin to the US dollar from capital gains taxes. What do you think
Right.
the implication of that is for Bitcoin, the asset? I mean, if this does
Oh, it's
happen,
huge.
yeah.
It's absolutely huge. I mean, he's more or less saying Bitcoin is money, and you can't tax money. And they've long taxed your gains and your capital gains in gold and silver, calling them commodities. And so if you invest in them and they make money, then that's an investment gain. And yet, realistically, the Constitution says only gold and silver can be money.
Hmm.
And so the notion that you're being paid, you have to pay a tax on the appreciation of your money, against the kind of money they create, which is the dollar, which of course is, the ultimate quote unquote shit coin.
Mm.
It's if he eliminates capital gains taxes on sound assets, sound money assets, it's a big deal. It's a very big deal. I mean, all of the things he's saying indicate to me that he quote unquote gets it with respect to how broken the monetary system is. I mean, all these words, these are very standard talking points among sound money people. And I think, I know that if we had sound money, many problems would be solved. There would be fewer wars. There would be no inflation, etc.
Absolutely. I think it's massive, and the capital gains tax elimination makes it so that even if we can't return to fiscal austerity, which in the United States is seeming like a huge pipe dream at this point, considering our debt
Right.
level, it
Yeah.
allows the citizens in the country to escape that currency regime anyway. So if the U.S. dollar is destined to fail as a result of our debt problem, doesn't matter. The citizens, without taxation, can then jump to a life raft. I think that's also one of the major
Exactly.
pieces here.
I agree. Completely agree.
For sure. Beautiful. Well, let's jump into the macro of it all. I have here the 3-month 10-year yield curve, and this is, of course, just one way of visualizing the huge policy error that the Fed is committing. What are your thoughts here? That we're about a week out from the Fed basically all but certainly hiking again. But what on the
Yeah.
planet is going through Jerome Powell's head right now?
Yeah. I mean, he's obviously trying to restore his credibility, which he lost. So, he lost so much of it when he said inflation was when the COVID reaction occurred, and then they grew the money supply 42% and sent out checks to everybody, and the Fed took the view that inflation was transitory, which was obviously just dead ass wrong. And when it was proven to be that he was dead ass wrong, he thought to himself, "Uh oh, I've got to try and restore sound money and my credibility." So I'm going to pull a Paul Volcker. I'm going to jack rates up really aggressively and get this inflation thing under control, um, which is fine, which is what he's done. And as I think you have a chart we're going to look at, inflation has come down, no doubt. I wouldn't say it's under control. There are a lot of data points surrounding that, but the yield curve inversion is incredibly steep, and it's almost a perfect indicator of a coming recession. I mean, you can see it in going back to the early 1990 period, but it also worked before that as well. So, and as Lynn Alden said, personal income is down, year over year, and every single time this has happened since 1948, which is her data series that she used to develop that, we've had a recession. In many cases, a very severe recession. So, you know, in my opinion, this economy is living on borrowed time, and there's a lot of denial going on. Another piece of data, I don't know if you have this or we should have, but is that credit card balances are growing very, very rapidly. And so I think a lot of people have suffered a hit to their economic well-being because their groceries cost more, and maybe their job isn't, the wages aren't going up as fast as they need them to, et cetera. And what are they doing? They're living by charging it, and you can do that for a while, but eventually the balance gets too big. And by the way, concurrently, interest rates on those cards are going up. I mean, the average card interest rate, as I recall, was in the teens, mid to low teens, maybe
Mm-hmm.
5 or 10 years ago. And now it looks like average card rates are up in the 20+% area. And as somebody pointed out, when you have a president who's from Delaware and all the card issuers are Delaware corporations, I guess usury laws just don't really apply anymore, right? you can let the card guys jack the interest rates. So it's all of a piece, which to me says that this economy is rolling over, and the Fed in their campaign to get the inflation under control, they're going to break something else. And in fact, it's not as if that's a theoretical. They did break something else. They broke Silicon Valley Bank
Mm-hmm.
and a couple of other banks, ultimately a big bank, a GSIB, Credit Suisse.
Yeah.
But they managed to stuff those back in the box with this BTFP program,
Yeah.
which is fine. They calmed the herd down. But I kind of I was around and very active as an investor and was short a bunch of stocks in the 2007 and 8 period. I had the Michael Burry trade on, not in the way he did. I didn't know what a CDS was, but I was short a lot of financial stocks. And this period right now kind of reminds me of Bear Stearns failing in March of 2008. As you remember, the GFC was in September, October. So something bigger is coming, in my opinion, and Silicon Valley Bank was kind of the first domino to fall, and there'll be more, over the course of the next year.
Indeed.
So,
Silicon Valley Bank, first domino to fall. It's a good way of putting it, because if you think about it, like, if the inflation battle, and we'll go back to this chart here, and I suppose we'll start talking about it too. If the rate hikes have done their job and bringing down inflation, with it's arguable if it was even the rate hikes, or if it was the fiscal surplus, or, well, we haven't been in one, or if it was consumer expectations falling. We didn't even know if the rate hikes were what brought down this inflation. But now that CPI is closing in on its targets, clearly decelerating. Now, the rate hikes, one of the only enemies left on the battlefield is these banks, right? These banks are holding
right,
interest rate sensitive assets, high duration, even US Treasuries.
right,
And of course, BTFP has been made, but it's not like banks only hold treasuries. They also hold loans. And if those guys
right.
default because of higher rates, it seems like with these continued rate hikes, if the inflation battle is won, it seems like banks are still in the crosshair from all this stuff. And that may be what the market is catching on to with this level of yield curve inversion.
I think that's right. I mean, I think, and I know you've got a chart. We're going to go to it eventually. I mean, look, there's easily another $500 billion of unrecognized real estate losses in the banking system. And in my quarterly report, which will be on Twitter tonight, we found a study that was done by a number of pretty impressive academics, and their view is that there's actually $2 trillion of embedded losses in the CRE market. And if that's the case, they actually computed that as many as 50% of the banks in the country could be technically insolvent. If things were properly marked in today's world. If that's the case, we've got one hell of a banking crisis coming up some point in time when those marks start to show up.
My
Yeah, here
goodness.
we go. Commercial property, right?
Yeah, it's a big number. It's a big number. When you start getting into the trillions, that becomes a pretty big issue. And not to
Right,
mention that of the closing in on $3 trillion in outstanding commercial real estate loans, 70% of them are held by small banks. And so if you take
correct.
that to its logical conclusion, then it's just further consolidation in death of those smaller banks, whether they end up failing and those assets go the way of the dodo and it becomes an FDIC thing, or it gets swallowed by one of these big four. It's just further consolidation into fewer and fewer banks and death of these smaller regionals.
Right, and as you know, last time around, Janet Yellen managed to calm everybody down, and they didn't have to come through with a full guarantee of all the bank, depositors. 16 to 17 trillion dollars of bank deposits in the United States, a large portion of which are uninsured because if you're more than $250,000, you're not the FDIC doesn't cover you. And it would be, I think, in the next wave, it's entirely possible that we see more banks failing, more problems, more depositors fleeing those banks, and the Fed has to step in with something bigger than the BTFP, more aggressive, maybe a blanket guarantee of all depositors. And to guarantee $16 trillion of deposits when your Fed balance sheet's $9 trillion, I mean, that's more than doubling your balance sheet, right? And so, I mean, there's a real problem here, Joe. I mean, I'm not telling you anything you don't know, but there's for people who kind of look out there and say, well, Silicon Valley Bank happened, everything's calmed down, seems like it's kind of good, stock market's making new highs. What may worry? It's all pretty good. And I'm kind of like, feels like '08 to me. Yeah, it felt okay in the summer of '08 too, but the problems were all still there, and they were just waiting to surface. And that's the feeling I have right now.
Hmm. And it's a feeling that's proliferating too. I don't have the chart; I couldn't find it, but CMBS delinquency has risen. Apart from, of course, the 2020 period, which was this sort of phenomenon, I suppose, with the whole COVID crash, has risen to a pre 2008 level, so like a 2006, 2007 level. And that's
Yeah.
not good because obviously commercial mortgage backed securities, they're not treated like pristine collateral anymore, like treasuries, but they
Mhm.
still represent a decent portion of collateral for global borrowing, not just US borrowing. And it could, like you said, set off this big chain of dominoes. And that's going to be a
Yeah.
big facility, much bigger than the BTFP, a big
Yeah. Right.
facility if the Fed ends up having to buy all that stuff.
Yeah. That's exactly right. And then there's the U.S. government bond market too. I mean, my report shows this, and we can talk about it. I mean, it's as you're probably aware, the U.S. 1-year Treasury is now making record highs in the 5.3, 5.4 area. I say record, I mean modern day record. Greg Foss corrected me on a podcast this morning. They were this high back in 1980 when Volcker was around, but we haven't seen 5% rates on the 1 year in a long time, and what that's doing is it's driving the government interest costs up, and so the government, U.S. federal government interest costs are approaching $1 trillion run rate, and that's up from 300-400 billion not that long ago. And so it becomes a vicious circle, right? I mean, interest rates go higher, everybody has to pay that interest, the deficits get larger as a result of those payments, and more bonds need to be sold. There are only so many buyers of bonds. Well, if more need to be sold and there aren't enough buyers, then what happens? The interest rate goes up. Well, what does the higher interest rate do? It makes the interest costs higher and the deficit bigger. So yeah, there you go. Perfect. Right. I mean, that's, I mean, look at that chart. How does that end well? You know what I mean?
You generally, generally speaking, when you're talking about a parabolic chart, you want to be talking about a stock price or something like that, and not
Right.
interest expense. Because, like you said,
Right.
it's kind of like an Ouroboros; it feeds on itself.
Yeah.
How
I
on
mean,
earth do
it's,
they fund this interest expense? They issue more bills and so on and so forth.
yeah. Right. And so, what I think is that in spite of Powell's rhetoric and actions to date, he is going to hit the wall. Um, and enough things will break that suddenly, and by the way, he'll have some cover. He'll be able to turn around and say, look, inflation came down to 3%, it's headed to 2. So now a bigger problem is all these banks are collapsing, the economy is collapsing, we've got unemployment really going up, stock market's down substantially. We need to take these rates down, we need to end this QT, maybe we need to go back to QE. All the kind of reversal things that will keep the economy together, but in turn, fuel the next leg of inflation. And one of the things, I think I've said this on the podcast, but I think it's a very important point. You and I talked about it before the show. It's really interesting to me that in spite of this big tightening on the part of Powell, over the last, since I guess February of 2022 is when he started. So, what is it now? 14, 15 months. Gold and Bitcoin have kind of hung in there. I mean, Bitcoin's still the best performing asset this year, up 83%. Even gold's up 8% this year. I mean, gold is within 5% of its all-time high of 2050. It's kind of a 1950 area. And so, typically, historically, with the kind of Fed tightening and interest rate jacking that they've done in the last year and a half, gold would be getting crushed and Bitcoin could be getting crushed because everyone would be thinking, well, okay, so, they're going to get inflation under control. And we don't need these inflation protection assets. Well, no. I mean, that's not what's happening. I mean, admittedly, they've stopped going up, massively. I mean, Bitcoin's not at 68,000, gold's not at 3,000 yet, but they've kind of hung in there in spite of a pretty aggressive tightening schedule. And my belief is that tightening schedule will have to be amended sometime in the next 6 to 12 months. And when that is amended, this stuff's just going to go crazy. I mean, this stuff being the sound money assets, because a larger group of people are going to say, you know what? They can just never stop printing. And that's what you and I and the sound money camp kind of fundamentally knows, that this thing's like a shark. It's got to swim or it's going to die. They got to inflate this system or the system implodes on itself. And so, right now they're inflating it less because they had too much inflation. But eventually, they'll come to the conclusion that the inflation's come within a reasonable range and all the other problems are bigger. And so they should inflate it again. And at that point in time, Bitcoin will go through 150 and gold will go through 3,000. So
Absolutely,
that's
and that
that's kind
seems
of
to
my
be
prescription of where we're going. The problem is that, that could be tomorrow, it could be a year. I mean, they're pretty good. I have to admit, they're pretty good at can kicking. And I further admit that I thought when Silicon Valley Bank happened, okay, here we go. It's all over, And yet they managed to find kind of an elegant, crafty way to kind of patch that up and not have everybody panic and, put the unspill the milk, so to speak. But I don't, I think the bigger problems are still there and it's going to spread. And so, they're only delaying what I view as kind of being inevitable.
absolutely. I mean, the problem, right,
Yeah.
is the clashing need for uh, elevated interest rates in order to bring down consumer price inflation, not have that run hot. But that also runs counter to the fact that we're issuing a tremendous deal of debt right now to fund ourselves now that the debt ceiling has been
Right.
raised. and higher rates clash with our ability to do that effectively. And BTFP is only a sort of the first, and what I imagine will be plenty more patchwork that goes over top of that to say, all right, we're going to rescue the financial institutions who are, and absolve them from interest rate risk here. But then it becomes,
Right.
how many other patches do you need, say for, like we discussed, commercial real estate? What about student loans? What about
Yeah.
defaulted on private student loans? What about defaulted on credit card debt? Right. So all these facilities, the Fed may just end up becoming the player du jour that comes in and saves the day
Yeah.
every single
Yeah. I
time.
love this chart. I mean, it's an amazing chart, isn't it?
Oh my
I
goodness,
mean,
it's completely
yeah.
wild. And the crazier thing is that this was released by the U.S. Treasury. So
Right.
James Lavish, a friend of the both of us, put up this. He said this is more likely what it's going to look like, and given that
Right.
this chart that we just saw, I wouldn't imagine it would be too far off. But the actual projection from the U.S. Treasury
I
is
know.
that,
Even they say it's going straight up. Yeah. I mean, right.
yeah,
Yeah. Yeah. I mean, even Powell admits it, like, we can't keep doing this forever. And so in light of that, I kind of think to myself, okay, fine. So how about somebody's a statesman and kind of says, and by the way, here's how we might want to address that. I mean, you're not hearing that. And I guess it's because in the game of politics, the name of the game is just kick the can. And as long as it holds together while they're there before they retire, then they get to write a book and receive a Nobel Prize or something. I mean, it's
was
it's
that a
it's
reference to Ben
nonsense.
Bernanke?
Yeah, yeah, yeah. But look, it is what it is. It's the system we live with, and it. I mean, my advice to my investors and to all investors in general is just don't take your eye off the ball. Which is, the debasement, as Foss says, the debasement is pretty much baked in and certain. The rate of debasement varies from time to time, so you have waves. And right now we're in a little bit of a down wave in the sense that, I mean, money supply growth has fallen
Mhm.
to slightly negative. The putting on the brakes has calmed down activity a bit in the economy, not as much as one would have thought. I mean, to me, that speaks to the fact there's just a lot of money sloshing around from 15 years or, ZERP. I mean, we haven't even, in my opinion, those people say, well, we can have a soft landing, go back to the economy being good. I'm just like, I just don't see that, because I think that we had an enormous bubble throughout the, I don't know, 20, call it the 2009 to the 2022 time frame, and it was the everything bubble, and you just can't correct an everything bubble with one bad year. 2022, when stocks and bonds are down 20%, that doesn't do it. That's not a full correction. There's still a lot of misallocated capital that got put to where it put because interest rates were zero, that will not sustain, will not entities that will not survive in a 5, 6, 7% cost of money environment. They just can't.
Hmm.
They just can't. You know.
Yeah, a much larger correction is due, right? I mean, like you said,
Yeah.
14, 15 years where entities existed off of 0% interest rates, and even if they didn't rely on those 0% rates, is still capital misallocation because
Correct.
of where those rates were. And there's, like you said,
Correct.
20% decline in stocks and bonds. That's not the correction that people should be
No.
looking for. It should be, I don't want to say economic upheaval, but something closer to economic upheaval and snapping companies and entities that borrowed at 0% rates back to reality. And that's going to result in a pretty big deleveraging, I suppose.
Exactly. That's my belief, and that process has only begun, in my opinion. And so I think everybody should fasten their seatbelt and hang on, 'cause it's gonna be kind of bumpy.
Here at the Bitcoin Layer, we're big believers in taking your Bitcoin into your own hands, and that's why we've partnered with Foundation Devices. Foundation Devices has created the best-in-class suite of Bitcoin cold storage solutions, so you can take your Bitcoin off of exchanges with peace of mind, regardless of your skill level. If you're just starting out with Bitcoin storage solutions, you can download the free mobile app Envoy, which allows you to take your Bitcoin off of exchanges in minutes and rest with the peace of mind that your Bitcoin is held safely and securely. And if you're a little bit more advanced, if you'd like to take the next level, you can purchase one of their devices, the Passport. This is the best-in-class Bitcoin hardware wallet. It is extremely intuitive. You'll know how to use it the moment you take it out of the box. It is a sleek design, a very familiar interface. Start taking self-custody seriously by taking your Bitcoin off exchanges by visiting foundationdevices.com or by clicking the link in the video description. And now back to the show. Kind of
Yeah,
bumpy
that's a good
indeed.
one too. I mean, And there's one in my quarterly report again. I'll be on the Twitter tonight. I mean, it shows that after each of these increases, the Fed had their own internal projections. It was one done by Ronnie Stoefferle, showing how they were going to wind their balance sheet down. I mean, I still remember it was out on recently on Twitter. Ben Bernanke telling Congress that he was going to take the $1 trillion or the $2 trillion of balance sheet debt that he ran up in the first QE, and he was going to unwind it. And he anticipated that happening within a year or two. And of course, we can see how that worked. You know, and and after each of these printing episodes, they talk about how they're going to unwind it. I mean, they tried to taper it in 2018, they couldn't. You know what I mean? And so it led to a bigger one. And so the next blow up, in my view, again, we put this in our letter. I think the next, the Fed balance sheet, the next stop is $20 billion, or $20 trillion. We're just under 9 right now. Because you notice that, how quickly it happened. I mean, it took a while. Fed balance sheet was 800 or 900 billion back in '08, but pre the GFC. And we pretty quickly went to 2. And then we kind of over a bunch of years crept up to 3, right? And then we crept up to 4. And then, okay, then we tried to stop it for a while. Even took it down a little bit, but that didn't work. And then bang, something broke and up we went. And we're at 9. And so, I mean, we could go sideways for a
I'm
while.
no expert in pattern recognition, but I think I may have an understanding of where this is headed.
Yeah, right. I mean, that's exactly. It doesn't take, a high level of education to see what's going on here. I mean, they cannot stop printing money. I mean, I say that they could stop printing money, and the economy would grind to a halt, and we would have a depression or a downturn that was really very much akin to the Great Depression. I mean, there'd be massive unemployment. There'd be trouble everywhere. That could happen. I mean, just as when people look to invest in my fund, one of the things they ask me is what could go wrong, and I always answer with them with there's only one thing that could go wrong. Of course, they laugh because they don't think this is likely, and neither do I. But I said, well, if the government suddenly got incredibly responsible
Mm-hmm.
and stopped all these military adventures, cut the military budget in half, stopped funding the Ukraine, means tested Social Security and Medicare, cut Medicare and Social Security benefits, balance the budget, truly balance the budget, well, then there wouldn't be as much need for gold or Bitcoin. I mean, the dollar would have more of a sound basis on which to go forward. But sadly, and I'm not saying those things can't and won't happen at some point in the future. They might. That might be one of the things they try to save the system. But I'd say today, those things happening looks like a very low odds, long shot kind of proposition. I mean, this debt ceiling that we just reset to an unlimited number. I don't know if they've ever done that before. I don't think they have. But as you know, they kicked it out until January or early 2025 after the next presidential election. And they didn't put a ceiling on it. They said, we'll set a new ceiling out there.
Mm-hmm.
And the conditions that the Republicans demanded for doing that was to put a spending cap, not decrease, but a cap where it couldn't grow on 7% of the budget. So 93% of the budget remained untouched. But this one, certain things they pulled out and said you can't grow these areas for 2 years. But those areas were only 7% of the budget. So, to me, it's just a joke. I mean, the politics are such that there's no appetite for raising taxes. There's no appetite for cutting expenditures, none. And that's a recipe for continued currency debasement because somehow you've got to square the circle, and really the only way to do it is to print the money to fill the gap. So
Absolutely. And I think that that's also what's so refreshing about a candidate like RFK. Even if it
yeah,
is a pipe dream, something like backing the US dollar imminently with hard money, it brings fiscal austerity into the national conversation. And I think a much
yeah,
better way of doing it, exactly like you said, would be to cut unnecessary spending. Why is our military budget bigger now than it was during any of the wars we fought over the course of the 20th century?
right,
And we're not actively engaged in combat right now. It's these big things that the government spends on, and the inability of any candidate, whether you're a congressperson or a senator or even someone working at the state level, it's usually never to bring down government spending. It's usually to create a bill that institutes spending and then never repeal it. It just gets bigger and bigger and bigger,
yeah,
and then
yeah,
you become the problem for your own currency.
correct. That's exactly what's going on, and it's most unfortunate, but it is what it is. And so it forces the rest of us to analyze it and then come to our own conclusions about where to save our money. And I think people who make the conclusion that, Bitcoin is the, is the best form of money in existence today, and I believe it is. And on top of that, it's also, under adopted and facing a really steep adoption curve. So the two for combo of it's a great form of money, it'll have a lower stock to flow than gold at the next halving, etc. You take that and you add on to that the adoption curve where, maybe 10 or 15% of the world or the US owns it today. And I think, in 15, 20 years, everyone will own some because everyone will realize that it's the safest place to put your money.
Absolutely. So let's talk about here
Okay.
the path forward for price inflation. I want to talk about
Yeah.
this, and then we'll talk a little bit about how the Fed's rate hikes are kind of putting consumers and businesses on the edge. Of course, you and I know a recession is a slowdown in economic growth, well, a contraction in economic growth. And now that rate hikes are finally trickling their way through the economy, we're seeing it visible in inflation, and eventually we'll see it in consumers and businesses too. What's your take on the current, the most recent prints of consumer price inflation? This is the 12th
Well,
month in a row
keep
we've
it,
seen
keep it. I mean,
declines.
yeah. Let's start with the premise that all inflation numbers are kind of cooked,
Mhm.
okay,
Yeah,
and always have been. But if look, the direction and magnitude. I mean, it's there is some data here that has some usefulness, and so the number came in at 3%, which was lower than expected. This is a headline number for last month.
yeah.
I think it was expected to be 4. And a big part of that, as we all know, a big part of inflation is oil prices because gasoline's a huge part, and energy a big part of everyone's expenses. And keep in mind that this has partly been cooked because Biden has drained the Strategic Petroleum Reserve.
Mhm.
And so it's my belief that we are now in an inflationary world. We were not for a long period of time from the 1980 when Volcker did his thing all the way until the peak deflationary moment, which in my opinion was March of 2020 when the 10-year traded down in the 56 basis point area. That was peak deflation. It was a blow off. And ever since then, we've been in an inflationary world. And it's going to be back and forth. There are going to be surges up and then a retrace and then a new surge up. If you look at the 70s, Tavi Costa has a great chart on it. It shows there were 3 waves of inflation, each had a higher high and a higher low. And so, pre 2020, I mean, if you recall, the Fed back in the 17, 18, 19 period said, well, inflation's too low, we got a problem. And partly because we'd had 40 years of deflation. That's how they were able to, with a straight face, in spite of printing a ton of money and sending out stimulus checks, they were able to say, the inflation we're having is transitory. Well, no, it's not. And so we are now in an inflationary environment. This 3% gives Powell some cover, which he undoubtedly wants. Will it go lower? Possibly. I'm not an expert on dissecting these numbers. Certainly, if the economy falls apart, demand will go down and prices will drop and it will go lower. Having said all of that, I think a lot of it's going to be dependent on energy. And a macro analyst that I follow, I think is very, just expert on this area, is Luke Groman, and he talks a lot about, the price of oil and the marginal barrel of oil coming out of the oil shale and fracking, in the Permian Basin and so forth over the last 10 or 15 years. I mean, the United States went from being a marginal producer of oil to a pretty major producer of oil as a result of that. And yet those fields are getting mature and are having hard time, staying flat, much less gaining production. And so if one assumes that we're kind of at Hubbard's peak on oil and oil is going to be in shorter supply on a go forward basis or harder to find on a go forward basis, that's going to be a big driver of inflation, in my opinion. And so, I fully expect that when this downward impulse ends here at some point, that eventually, it will reverse and go the other direction. Now, the other thing about inflation is it's somewhat psychological. Um, if people think there's going to be inflation, well, there's going to be inflation because they'll rush out to buy things before the price goes up,
Mhm.
right? And also, if your neighbor sees inflation and your neighbor's getting a wage increase, well, then you want one. And two data points on that front recently, I'm sure you saw them, was the airline pilots. United Airline pilots, I think, got wage gains of between 37 and 40% over a couple year period. It was like 18% in the first year. I mean, good Lord. I mean, I know apparently there's somewhat of a pilot shortage, but an 18% annualized increase in your wages, that's a big number, right? And of course, that was seen by the United Auto Workers. And the head of the United Auto Workers came out and said, "Hey, all our union members are, working their asses off building these cars, and everything they buy is more expensive. We're ready to strike too, unless we get something similar." So, what the thing the Fed can do is, yeah, they can raise interest rates to try and calm down the monetary conditions, slow the economy down. But the fact of the matter is, if inflation's there and it gets into the wage equation, which it appears to be doing, then it's a real problem because if people want higher, and the labor markets are pretty tight, and that's another problem unto itself. I mean, we've got the exact opposite of the 1980s when all the baby boomers were entering the workplace. Now all the baby boomers are exiting the workplace. So you've got fewer younger workers, and I mean, as talk to anybody who lives in the suburbs and tries to get an electrician or a plumber to come to their house, and then look at the price of it. I mean, these guys are killing it,
Oh yeah.
right?
Oh yeah.
Yeah. And so it's there's a shortage of workers. So what does that mean? Well, it means people are going to be able to demand higher wages and get them. And so I think we are in an inflationary decade. I think this is going to look very much like the 70s on steroids. And the 70s was when we coined the term stagflation, which meant kind of inflation without any growth. I mean, maybe the top line is growing, but remember, if you're selling the same number of widgets and the price per widget is higher, well, then you record a growing sales figure, but you didn't really sell any more widgets. There was no unit growth. There was no fundamental growth. And I could see that. I could see a very slow unit growth environment with higher prices for everything. And that's what we saw in the 70s until they slayed that inflation beast. And interestingly enough, I mean, as you'll all recall, it took Volcker had to take interest rates up to 20% to slay that. I mean, we're at 5% right now, and Silicon Valley Bank blew up. I mean, 10% would, I think, blow up the world. 20% would annihilate the world. So I don't think those choices are in their toolkit. So to be honest with you, Joe, I don't really know how the hell they're going to get out of this. I mean, I don't. I mean, I think they're going to. My sense is they're going to print as necessary to keep the system going, and they're faced with two very bad possibilities. One is complete, collapse, and I know they want to avoid that. And the other is high inflation. I think they want to avoid that too. But I think when the choice is collapse or inflation, I think they'll view inflation as the less painful of the two choices. That
I
the
think
total
so too.
collapse,
Yeah.
yeah, the total collapse scenario, they just can't let that happen. They won't let that happen. And we saw that in 2008. I mean, you had, the big TARP bailout and everything else. They said, oh, the ATMs aren't going to work. And I mean, they just did what they had to do. They printed the money. In March of 2020 on the COVID crisis, same story. The world's going to come to an end as a result of this virus if we don't print this money. And they printed ungodly amounts of money. And so, we're going to see another one of those. And they're going to print more ungodly amounts of money. That's my estimate. Now, don't ask me to tell you the exact timing on that because nobody knows, especially not me.
Absolutely. Time and time again, that seems to be the solution because people forget they hate deflation almost as much as they hate inflation or even more.
Well, that's right. I mean, inflation, people bitch with inflation, but if we get, a complete economic collapse and in kind of a pyramiding manner where people are losing their jobs and therefore they're not buying cars, therefore the car manufacturers not making, like, if we get massive layoffs, we have to remember, I think in the 30s, I mean, unemployment rate at one point was like 30 or 40%. I mean, the economy just wasn't working. It was just everything shut down. I mean, the whole damn thing shut down because nobody had any money. And of course, that's what led Bernanke to do all the stuff he did and to vow that they would never let that happen again. He even had a speech about it, and where he talked about helicopter money. If need be, we can drop money from helicopters. So, and we saw that. I mean, look at COVID. I mean, the stimmy checks were a good example of that. Hey, this economy is in deep shit. We got to, people don't have enough money. Everybody's hurting. Everyone's stuck in their house. We need to send you a check. And, I mean, universal basic income was talked about. That could come back. I suspect it will come back. So having said that, all of those things are extremely inflationary. Extremely.
Absolutely.
So.
So with these rate hikes, on the flip side of the coin, of course, the other effect that tightening lending has, or raising these interest rates, the Fed's policy interest rates, it tightens lending, and that's the idea, right? The idea is to,
Yeah.
if you want consumer prices to go down, you make it harder for consumers to spend. Let's talk about the state of the consumer then. So this is the senior loan officer report that comes out quarterly. And this is basically surveying respondents, you know, this about whether they're tightening standards on consumers or loosening standards. And we are currently at a net percentage of respondents that are tightening standards at a level that is consistent with pre-recession, pre-2008, even in 2019, this was rising, so pre-2020. And right now, we are at that exact same level that is, again, consistent with this contraction of economic growth. What's your purview here? Do you think that we're going to get a soft landing, or do you think that with the state of the consumer the way that it is, do you think that we're bracing more for a hard economic contraction?
I fall into the hard crash camp. I mean, but I could be wrong. I mean, soft landing is entirely possible. I mean, there are shock absorbers. I mean, one of them, for example, is I read the other day that like 25% of the 25% of the workers in this country are working for some form of government, and so they're not necessarily going to get laid off or lose their job. They're kind of locked in, right? Um, and they've got COLA increases, so it's not maybe as vulnerable an economy as it has been in the past, but um, you know, my opinion is that when it tips, it'll cascade on itself fairly quickly. I mean, the you know there will be it's I mean it's leverage on the way up and it's leverage on the way down, and everybody in this economy is carrying a lot of debt. Everybody's very heavily leveraged, and if that debt starts to go bad and people can't make their payments, the cars get repossessed, the car prices fall, the auto manufacturers don't need to make as many cars, so they lay people off. The people who get laid off can't make their mortgage payments. Those houses get put up for sale, and it compounds itself. It's just one after the next, and two very good instances of this, and I think at smaller scale, but they were meaningful. Are the dot-com bubble in 2000, which was really restricted mostly to technology stuff, but the Nasdaq went down 80%. U.S. stock market went down 50%, and the housing bubble of '08, where the housing stuff went down 90%, some of the stocks, and the stock market itself went down 50%, and overall general stocks, and unemployment shot up, and government deficits shot up, and you had real pain, and I just don't see how this episode doesn't ultimately look like those two episodes. Um, it may be taking a little longer, and in both of those cases, there were precursors to the big down. I mean, and I was investing in both those cases. I remember 2000, March of 2000 was the top, and some of the really high flying speculative stuff kind of started to blow up. But Cisco, IBM, all those guys, they were fine. It wasn't until a year later that all the big names started to really fall apart. And so it takes time. The economy is an ocean liner, and you can't just change direction on a whim. And we've had a bunch of years of growth, and we had a bunch of financial stimulus in 2020, and there's a lot of money out there flowing around. And so, but the Fed's trying to sop it up with these higher rates, and slowly but surely at the margin, people will stop doing silly stuff because money's not free anymore. And at the margin, I mean, think about, just as an example, think of all the unicorns there used to be, and all those dot-com companies, and just high-tech companies out in California that weren't profitable, that were funded by venture capitalists, right? Think of all those employees who thought they had millions of dollars in stock options, and they had nice big salaries. I mean, I know some of these people because my kids have friends that worked in these companies. And now the venture capital's dried up, and the venture capitalists are about to get their asses handed to them, right?
Mm-hmm.
And so the funding is dried up. And so if you're in one of those companies that's not making money, your job's at risk, right? And so, you had a pretty high paying, decent tech job, and guess what? Now it doesn't exist anymore because the funding is dried up. And so, you're not buying a car, you're not buying a house, you're not doing all the normal economic stuff. You're taking a job probably paying you less than what you were making, et cetera. So, these things, it takes time for these flows to occur, but the wheels grind slowly, but they grind surely. You know what I mean? And so I mean, having watched, I'm 66, I've been doing this since I was in my 20s. having watched a bunch of these cycles, I can just say with high confidence, I just know that's what's coming. It's coming. It's taking a little longer than I thought, but it's coming. You
Absolutely.
know,
Very well said when you said the economy is an ocean liner, and we're slowly but surely we're making some kind of return. And you mentioned that corporations, it's the fragile ones that go first, and then
right,
ultimately a lot of the damage is done over time to the less fragile ones. Right
right,
now, and we talked about this beforehand, this is what distressed debt looks like. So for the viewers at
yeah,
home, distressed debt means loans that are trading below 80 cents on the dollar and bonds that are trading at a 1,000 basis points spread or higher to their corresponding treasury bill, note, or bond. And this happens as a result of traders opting for higher yielding instruments than the corporate bonds and loans they're holding. And this will make it more difficult for corporations to take on debt when they need to roll. And given the fact that there is several $100 billion corporate maturity wall this year and next and next, this is a pretty disconcerting thing. What are your thoughts on this as it pertains to the
I couldn't
ocean
agree more.
liner?
I mean, this chart is horrifying, and I mean, look, I mean, in when you make money expensive, everyone who's been borrowing money cheap and thought that was easy to do suddenly discovers, holy shit, I got a problem. And so if they've got to roll their debt over, one, they may not even be able to roll it. They may have to pay it back and they don't have the money to pay it back with. Or two, if they do roll it, it's not going to be as cheap as it used to be. And they're going to spend more money on it. And both of those things are bad for them, the personal balance sheet and whatever business they're in. So, or the business balance sheet, whatever business they're in. So, I mean, and that's actually, it's ironic. It's one of the sad things about what the Fed has done. Some of the problems that we've had with inflation are supply oriented problems. I mean, we had just bottlenecks and issues. We need more supply of certain things. Well, how do you get more supply of certain things? Well, you spend capex to create, capital goods that then give you supply. Well, okay, how do you finance capex? Well, either equity financing or debt. Well, when debt was cheap, it was easier to finance capex and bring on that additional supply. You jam the interest rates up, and then suddenly, it's not so easy to finance the capex and create the supply that you need to get the inflation down. So it's not as though these interest rates being higher is a definite guarantee of we're going to get inflation under control. I mean, they're parts of higher interest rates which do slow the economy and which help get inflation under control. There are other parts which don't. I mean, the debt doom loop of the government and the difficulty of adding capacity, which is needed, which you need to add. So
The rate hikes are demand destruction focused, but they do not help with bringing supply back
they
into
don't
play.
help with supply.
Yeah.
No, they actually work against that. And so I look at this chart as you post here, and I'm stunned at how big these numbers are, and they're dead ass serious. And I'll bet when this is all over, half of that money is going to money heaven. There gonna be a lot of people taking write offs on this stuff, and and by the way, Joe, that's another thing I would add just on the overall economy. I think people forget how much people's spending habits are driven by their perceived level of wealth. And I
Mhm.
think a lot of people in the middle to upper middle classes, their perceived level of wealth is kind of their retirement account, their stock account, and they look at it and they say, well, okay, I've got X thousands in my, in my investment accounts. And oh my, look at that. It went up, 20% this year. Great. I'll take a vacation to Europe. I've got,
Mhm.
I'm doing fine. Well, you know, um, bring on the downturn that we're talking about, cut those stock accounts in half, which is what happened in 2000 and 2008. And suddenly that retirement account that you thought was nice and a certainty and growing and going to give you a nice retirement, and you were comfortable spending a little extra money. And it's like, holy shit, we got to cut back here. I got to make this car last longer. Europe, nope, that's off the table. All those nice expenditures, I'm trimming those. So, there's in a financialized economy the way ours is, these all of these markets send signals, and we as human beings we tend to herd. I mean, I think one of the things is one of the fascinating herding behaviors that I've noticed of late. I'm sure you have too. Is the way the stock market's really recovered. I mean, if anyone had told me the stock market was going to come back close to its all-time high after it peaked in 21, after it fell 20% in 2022, I'd have said no way. I mean, no way, absolutely, it's impossible. And yet here we are. We're within a spitting distance of that high, and all because of AI. And AI is going to change the world, and we've got this huge product. Don't get me wrong, AI is really good. It's important. It will affect the world, but not to the tune that it should make the stock market do what it's doing. And also, if you look at the stock market, as I'm sure you're aware, and many of your listeners probably are too, 7 or 8%, 7 or 8 companies account for most of that gain.
Yeah, if you look at Dylan posted a chart yesterday, it was fascinating. It was mega
Yeah,
cap tech is basically the entire stock market at this point.
right. That's right. And so, look, I mean, to me, these are unhealthy signs. I mean, when you get a market with very narrow leadership, the way, and this is a long time ago, but I was around in the 70s, the Nifty 50. There are 50 companies that you just could. The thought was you could pay any price for this; it doesn't matter. They're the best companies in the world. And forget about price. You just got to own these names. And of course, that ended very badly. The entire Nifty 50 was down, 50% in the next bear market in '73. And this has it rhymes, right? The history on this rhymes. I mean, these 7 companies, look, they're good companies. Don't get me wrong. I mean, Google's a fabulous company. Some of the others are pretty good companies too. But are they worth the kind of prices and multiples being paid in today's market? Debatable. Certainly debatable if the economy gets a lot softer, right?
Absolutely. And it won't be long before the mega cap tech names of today that are trading at triple digit PE multiples will go the way of the Nifty 50 as well, arguably, at least a great deal of them.
Well, they'll be around, but they won't. They just won't be. They won't be where they are today. I mean, Cisco was the hot stock of the .com era, and they provided all the right routers which built out the internet. It was a thing of beauty. It was a fabulous company, but it traded up to just an enormous PE multiple and price sales multiple, and then in the bust it fell. That those multiples came out of it, and it still hasn't reached its old all-time high. It's still a good company, but these valuation bubbles, this is hurting, right? People just, they it's everything works until it doesn't, right? And then it doesn't
Absolutely.
work at all. So you got to be careful. I mean, that's the nature of crowd psychology. The so
Absolutely. Everything works until it doesn't. Extremely well said, Lawrence. Before we sign off here, um,
yeah.
is there anything else pertaining to financial markets, the Fed, the economy, hard money that you want to leave our viewers with
No,
before we
I
sign off here?
no, I would just say to all viewers that be very optimistic, because this is a tough period, I think, for the country, the economy, and we're in this fourth turning, which is going to a lot of turmoil. We all know it, politics, etc. And I would just say try to take a longer term view, and take care of yourself and your family, and recognize that better times will come as we come out the other side of this. But in order to come out the other side of this, we need to return to a sound money standard. And that's what Bitcoin's all about. That's what gold is all about. And that's what those of us, that's what Robert Kennedy is now talking about. And so I think if anyone wants to contribute to that effort, that's a worthwhile thing to do, because the sooner we get to a sound money standard, in my opinion, the better off things will be for our kids and grandkids, which is certainly kind of why I'm working as hard as I work today. So sound money is, my byline on Twitter, and I think I stole it from Marty Bent, so I should give him credit. But my byline on Twitter is "Fix the money, fix the world," and I really do believe that's true. At the base layer, the money's broken. Fiat people have really, they've screwed this thing up massively. They've caused so much suffering in terms of inflation and the Cantillon effect, and the way poor people have suffered at the hands of billionaires. I mean, it's awful. It's absolutely awful. But it's going to end. The good news, that's the bad news. The good news is it's going to end, and the reason it's going to end, there are two great technological innovations that get me more excited about anything else I've ever seen in my life, and they are the internet, which is decentralizing information and allowing Joe Rogan to be more relevant than CNN or Fox News, and Bitcoin, which is decentralizing money and allowing an alternative money standard that the government can't screw around with, and so that we can save and know that our savings won't be debased. And I don't think today much of the world fully understands just how important those two innovations are, but I think they're earth shattering. And so I think in the next 10, 20 years, things are going to get so much better as those innovations roll out at full scale. So I would say, as bad as some of the shit is today, be optimistic. That's my message today.
Beautifully said, and I'd have to agree with you there. Better times are ahead. Be optimistic, control what you can control, fix the money, fix the
Right.
world. Lawrence, it's been a great conversation once again.
Thank you, Joe.
Of
Always
course.
enjoyed it. Yeah, someday we'll have to have one of these and we'll talk lifting. Okay.
Oh yes, yes, yeah. We'll have you back on the show, and we'll talk all things bodybuilding. But we'll get a lift in at some point. We've been to so many conferences at the same time and haven't gotten a lift in. I don't know how, but one of these
Yeah, no,
days we will.
we got to do that. If you're going to Pacific Bitcoin, we always do a CrossFit WOD. Maybe we could do a lifting WOD out in Santa Monica.
Hell yeah, absolutely. I'll be there for it. All right, beautiful.
Okay,
Lawrence,
nice chatting with you.
of course, likewise. Before we sign off here, where can people find you?
Oh, I'm on Twitter under my name, Lawrence Lepard, and I have a website, EMA2, Edward Mark Alpha, the number 2.com. My newsletter comes out quarterly. I should say my partner's in my newsletter. Dave Foley is my partner. It comes out quarterly, and it just talks about these macro things. And I run an investment fund focused on this. If you're a qualified or accredited investor and you can have an account size of over 200K, and I'm embarrassed it's that big, but that's what the SEC tells me it has to be. If you have an account size of over 200K and you want to inquire about that, happy to. We do take on new investors from time to time.
All right, phenomenal. Lawrence, thank you. You heard the man. Go give him a follow, and I'll talk to you again soon.
Great. Thanks, Joe. Take care. Have a good one.
Likewise. Special thanks to River for sponsoring this video. Purchase Bitcoin with 0 fees when you dollar cost average, and know that your Bitcoin is held in a proprietary cold storage solution so you can sleep soundly with peace of mind. You can also set up a hassle-free turnkey mining service where they host a Bitcoin miner for you so you can invest in Bitcoin mining without having to set it up on your own. River is changing the game when it comes to investing in Bitcoin. They are the best-in-class solution. They're my preferred method for purchasing Bitcoin. Invest in Bitcoin with confidence today at river.com, or get a special offer by clicking the link in the video description below. Again, a special thanks to our sponsors over at River. Have a good day, guys.